Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting with regular guest Greg Weldon, who's kind enough to join us. Greg, I know you've been impacted by the storm, unfortunately, but let me get right to the markets. First question I want to ask: let's talk about the general equity market, the S&P 500. I guess kind of a point blank question, but have we seen the top of this cyclical bull market?
I think there's a good chance that the move next is to the downside. Whether you've seen the top of this bull market, whether you get another bull phase down the road, facilitated by the Fed again, remains open. So I'm not going to make that equivocal statement. But what I will say is, to me, clearly over the past, I don't know, since the election, really, the onus has turned on the bulls to prove their case. They don't have a macroeconomic case. And you have a fiscal mess in front of us. You have an unsolved Europe with a central bank that has pledged to buy bonds but has not yet done so. You have a central bank in China which is tighter rather than easier. You see that in real rates are actually rising, and their currency is appreciating, but it's appreciating, and the dollar is not, dollar index not making its own subsequent low. Lot to chew on. Not much positive in there, that's for sure.
A quick follow-up there, since you mentioned China. I was reviewing global markets over the weekend. In Hong Kong, the Hang Seng is actually one of the strongest I could find. It's above the long-term moving averages I like to watch. Can we make anything out of that, positive or negative? I mean, what's your opinion on that?
Well, I mean, there are certainly positives, and you can make them out to be positives. The question then becomes, is that a second, third, fourth derivative from, the major final demand center, which remains, to whatever degree the developed countries and China. So I think their proximity to China, their proximity to the place that is actually still growing, certainly puts them in better stead than most places around the world. Having said that, you have to be careful here because it could be one of those things where everything gets swept up in a liquidative mode, in a mood to, shore up protection. And I think you see that reflected in the fact that gold in many currencies is rallying, and that gold in Chinese renminbi is actually threatening to break down. So you have a lot of cross currents here that suggest that those, third and fourth derivatives, while still positive, doesn't mean they don't have risk here. And certainly the degree to which they have priced in those positives becomes a whole other, thought process. And I think that too would bode, towards the protective side right now, given the macro backdrop.
Yeah, you mentioned gold there, and I also noticed the same thing. It looks very strong against pretty much everything except treasury bonds and the dollar. Well, I guess we can get into the stocks a little bit later, but something I was, up until a couple of days ago, the stocks were looking so much better than the metals, which was a good sign. But you go back to today and the last couple of days, the metals are showing more strength than the stocks. I mean, what are your thoughts here, kind of short term, on the precious metals and the shares? Are we getting down to a point where we should see a rebound, or could we perhaps see more weakness?
I think there's a lot going on there that provides opportunity, in fact. And I think when you mention the currencies, the first thing you got to note is that gold in the Chinese currency. This is a critical market to me. It's really threatening the downtrend, the entire uptrend rather. It's threatening to violate the uptrend, threatening to violate long-term moving averages. Has a technical pattern that is right now suspect. When you talk about the place where they have room to maneuver from a monetary standpoint and from a fiscal standpoint, you're talking about China. You're talking about a place where they have very high real rates, which gives them a lot of latitude to cut, and so on and so forth. They have deposit growth that has exceeded credit growth, which suggests that while credit growth has been robust, it's not bubblicious to the point that it's not supported by the income derived from exports. Now, you can talk about building all you want, but if their exports go down, that's back to a function of the U.S. consumer, the EU consumer exports to the EU from China. I mean, abysmal in the most recent data. I think when you put all of that together, it comes down to watching gold in renminbi. And then when you talk about gold versus equities, I really like the trade being long gold and short the S&P. To me, that's very similar to extrapolate out to the other precious metal, silver. And when you start talking about equities, you can link them maybe to copper, and you start to talk about really honing in on the dynamic that is at hand. And that is a macro economy that is not fixed, is not producing jobs enough to cover employment growth, population growth, is not generating any even nominal wage growth, and in fact real wage growth is deflationary. Is housing stable at best but not producing wealth reflation? That really has left only the asset markets, and without that, it's a really kind of a dire circumstance. That is derived benefit from the Fed. If the Fed is producing only half as much monetization as they were in QE2, and if you look at the fact again that the dollar index is not making a new low, this is not debt monetization, dollar debasement going on. And this is why asset prices, to me, are all of a sudden, seemingly, under pressure. But it's all of a sudden because you've removed the uncertainty of the election and exposed all of this, very quickly and very obviously, let alone the fear factor related to the fiscal cliff. So I like trades like being long gold against the S&P, being long silver against copper, stuff like that, and watching renminbi gold very closely for clues as to when this could get really deflationary, potentially for equities in particular.
Now, as far as precious metals, gold and silver, nominally speaking, does it just come down to when we see more action from the Fed or maybe some new action from the Bank of China?
I don't know. I really don't. I think that this has so many different ways it could play out, and I think that right now that circumstance may have passed its time unless the ECB grabs the lead and grabs the lead aggressively. It would be nice for the PBOC to play ball, but they're not playing ball. They're playing hardball. In fact, they're not buying treasuries. They're watching all of this from afar. They're actually, if you look at their 6-month rate of change in their treasury holdings, it's down. They've divested from treasuries in the last 6 months. So this is very interesting when you kind of start to tie this all together, politically, and start to think about outside the box what could be going on that we can't necessarily define. That too is not necessarily leaning towards a positive, but at the end of the day, I think the Fed will be back in play, the ECB will be back in play, the PBOC will be back in play, and the BOJ will be back in play. The problem is those quantitative maneuvers do not address the underlying macroeconomic dysfunction. And that is why I like stuff like gold versus S&P. Because gold will benefit from the monetization. Gold will benefit from the fact that they are going to try to debase, an increasing number of currencies more aggressively, theoretically. Not that that's the right thing to do, but it's the only thing they can do. To think that they can agree on fiscal solutions, I think is kind of foolhardy. They'll be pushed to the edge. They'll agree on, some subpar measures and, continue to extrapolate this problem until one day all of this doesn't work, and that's the bottom line.
I want to get back to precious metals, but first I want to talk about the bond market. Greg, something that I've noticed, which has been brought to my attention the last couple of weeks, fund flows into bond funds have hit an all-time high. Now, a lot of people would immediately associate that with treasuries, but it's not. It's with the junk bond, the corporate bond market. So we see all these flows going in there, and that, in contrarian terms, when you see that, usually that's a very bullish sign for treasuries, because as you know, Bernanke keeping rates low, it's forced pension funds to move up the risk ladder and speculate on junk and corporate bonds because they can't get any yield. What do you see this kind of turning into? I don't want to use the word crisis because that's kind of strong, but what do you make of the situation?
Well, I think you paint a really interesting and accurate picture, and if we were to continue to use that same paintbrush, let's consider for a second, you look at some of the stock indexes, and you look at the degree, and you look at some of the stock indexes and ETFs linked to stuff like mortgage bonds, for example. You see this relative play since the last fiscal cliff issue a year ago, okay? July leading into August of 2011, you had the big decline in prices. You are much higher in price in most everything, especially if you look at the ETF universe as it links to the U.S. sector stock index type ETFs. And yet the fiscal issue is much more problematic this year than it was last year. Public borrowing's up over $300 billion year over year. It's been over $1 trillion in each of the last 2 years. It is worse, case closed. And how do you not suspect that this could set up for a fiscal cliff dive that is much more significant than last year's was? And this comes back to the question of, how ugly could it get? How ugly will it have to get to force politicians to do something? And this is really throws the onus back on the political side. It's hard to handicap, my bottom line always is, you think they're going to really agree 4 to 5 weeks, 3, 4, 5 weeks, however many weeks ahead of whatever deadline they might have? Of course not. They're going to be pushed to the edge. The fear factor will rise in that interim. The market is set up for that fear factor to be really negative. And that's what has me, like kind of eyes opened all of a sudden since the election. This has kind of, mutated very quickly into this.
So is that I mean, aside from the bond market, is that going to have an impact on other asset classes?
Well, yeah, I think it does. And I mean, I think, in terms of the bond market, that is still the battlefield, and it's still the bigger problem down the road. So, looking at it from this perspective, without even including a bond market potential, implosion, is interesting as well, because what happens if we kind of transpire out of this and they don't come up with a solution and the bond market implodes? I mean, that would be really ugly. It would be a situation where the Fed would have to be uber aggressive, even beyond what they've been. Will they have the political will? Will they have the stomach to do that? Don't know. Those are questions that, unfortunately may still have to be answered.
Okay, now before we close, because I do have to cut this short today, as far as gold and silver, I know in relative terms, and I actually just posted a public article about a lot of what you're talking about, but how about in nominal terms? Is there a level that you like gold nominally speaking? Is it on a retest of that recent low a couple weeks ago, or what are your thoughts there?
Well, I mean, I would certainly like to see how things were playing out if you got to certain levels. In the December gold contract, 1740, on the futures contract, which is just a very short-term interim high from earlier this week or Friday, is a pretty decent breakout pivot if you would want to buy it on that strength, assuming something were providing a catalyst for that move. You do have a pretty well-defined downside kind of risk pivot off the most recent low. It's just in the 16. I'll pull it up for you right now. 1671. So that's roughly $60. You got the 200-day moving average down there. It held perfectly. There was a reversal pattern off of that low that does set you up where if you did want to take a stab at the long side, here might not be a terrible place to do it. I do prefer it against other currencies. I think the dollar will be strong here. So, I think euro, yen, either one of those, euro currency, yen, and a host of emerging market currencies to people with FX capacity are better plays to be long gold.
And what about the gold stocks? Are you watching GDX or the HUI? Like I said, I mean, a couple of weeks ago they were holding up so strong, and then we've just seen a complete dump the last 3 or 4 days. Could that be an indication that maybe we're kind of getting to the end of this correction?
Well, what happens is they get lumped in with paper, and to some degree they should be, and to some degree that hurts them. And this also shows you that this is a fear play too. I mean, this is something where you are seeing anxiety rise rather quickly. If politicians don't step in and get ahead of this, that will only intensify, and that should serve the metals, the underlying physical bullion, better than the paper stocks. There's no doubt about it. It's one of these things where you're getting kind of disinvestment in the equity sectors across the board. The best sectors, I mean, the REITs, the mortgages, like we were talking about, the mortgages, the technology select spider, stuff like this. Go on, consumers, the consumer staples, the consumer goods sector, right on down the line to the dividend plays. Think of how much money has been put in dividend plays in the equity market out of bonds. You talk about the flow. There was a great flow, too, over the last 12 months, previous to the most recent numbers, showing flow out of bonds into equities, into dividend-type yield plays. The dividend yield story relative to treasuries, which yield nothing now, was very enticing. Some of those things are down as much as 8%. The yield does not pay 8%. It doesn't compensate for that loss. You're now talking about potential wealth deflation. This is where it takes on an air of something larger should it get out of control. And that's kind of something I'm seeing is the breadth of the breakdowns technically, the similarity in the chart patterns, the uniformity here in terms of the money invested in them too, not even to the point of liquidation, even close yet. That's troubling.
Okay, Greg, as we close here, why don't you let our listeners know about the work you do, and I know you offer a free trial, so why don't you explain that? Yeah,
any of your listeners are welcome to go to the website, which is www.weldononline.com. That's one word, WELDON, is weldononline.com. We offer the Money Monitor. It's our flagship product. Attached to that is the Trade Lab, gives more specific trading ideas in foreign exchange, ETFs, commodities, futures markets, across all the spectrum of commodities as well. We have the Metal Monitor, which is an audio-visual, gold, silver, industrial metal specific. It's once a week. It's me talking with charts up, and that's all pretty good. And we have 2 managed accounts programs going right now, actually 3, 2 in the commodity space. One's a metals only program with a small minimum investment. Information on all that can be found at the website.
Okay, Greg. Well, thanks so much for taking the time today. I really appreciate it, as do my listeners, and look forward to talking to you again soon the next couple of weeks.
It's my pleasure, Jordan. Anytime.
Okay, thanks.
Take care.